Most business receipts are taxable, but on the EA exam, they love the exceptions. Your job is to sort cash coming in into 3 buckets: taxable income now, tax-exempt income that's never taxed, and tax-deferred items where tax is pushed to later. A 4th gotcha bucket is non-income receipts, money that comes in but really creates a liability or changes equity, not revenue. Tax-exempt means it keeps its character even inside a business. The classic example is municipal bond interest. If a partnership or corporation holds muni bonds, the interest is still tax-exempt. It may still show up on an information return or K-1 for reporting, but it's not included in taxable income. Exam tip: don't confuse reported with taxed. Deferred income is different. It's not exempt, it's postponed. 2 big deferral concepts: a Section 1031 like-kind exchange of business or investment real estate, and an involuntary conversion where you properly reinvest. In both cases, you don't escape tax. You usually carry over basis, so the gain shows up later when you sell without another deferral event. Now the sneaky category: money that isn't income at all. Loans are the easiest example. Cash comes in, but you also owe it back, so it's a liability, not revenue. Same idea with issuing stock. The corporation receives cash, but it's an equity transaction. On the EA exam, if you see borrowed funds or issued its own stock, your income meter should read 0. Sales tax collected is another favorite trap. If the tax is imposed on the customer, the business is just a middleman. The cash comes in, but it's owed to the state, so it's booked as a liability. When remitted, it's not a deduction either, because it was never income. In other words, not revenue, not expense, just pass-through money. One more exam-tested deferral: certain advance payments can be recognized over time, but only within limits. For an accrual basis business that receives payment for services to be performed, you may be able to spread income as it's earned into the current year and the next year, but you generally can't push it beyond the next tax year. That's the key timing limitation they'll test. Which of the following types of business income would not be subject to self-employment tax? The choices include fees for services performed as a notary public, profits from a sole proprietorship, rental income from renting personal property like equipment, and a general partner's distributive share of partnership income. Think about which one is specifically carved out from sell-eat tax rules. The correct answer is fees received for services performed as a notary public. That income is reported, but it's specifically excluded from self-employment tax under the Schedule SE instructions. A tempting wrong answer is rental income, because real estate rents often avoid SE tax, but this option is rental of personal property, which can be treated as SE income when it's part of a business activity. Summit Horizon Media Incorporation with publicly traded shares. During the year, it issued 1,000 shares of treasury stock and sold them on the open market. It received $205,000, paid $13,000 in issuing costs, and the par value is $22,000. What amount of gain does the corporation recognize? Think about it. The answer is 0. A corporation does not recognize gain or loss when it issues or sells its own stock, including treasury stock. The issuing costs don't create a deductible loss either. They're capital in nature. A very tempting wrong choice is $183,000, which is the cash received minus issuance costs. But that's not how stock transactions are taxed to the issuing corporation.